Now, when you pick financial statement of companies, right, and other entities, okay, you would see revenue, less cost of sales, and then we have the gross profit. Then you see less distribution expenses, less administrative expenses. Then we have profit from operations. Then we have add other income or finance income, less finance cost, and we have what? Profit before tax. Then you have your income tax expense for the year, and then we have what? Profit after tax, right? The tax element, the tax amount, the amount of tax to charge in the profit or loss account is covered by the standard IAS of income taxes, right? So welcome to IAS of income taxes. This is CN Professional Institute. Let's start. The amount of income tax expense to record in the profit or loss account, as we have stated, is made up of three main things. It's made up of three main things. The first one is what we call over or under provision for the previous year. Over or under provision for the previous year. The second is current tax. And then finally, we have what we call movement in deferred tax. Movement in deferred tax, right? So this is how we get the amount of tax expense to record in a profit or loss account, right? We said the first one is what? We have what we call over and under provision from the previous year. We have current tax and we have movement in what? Deferred tax, right? So we sum these three things, and that's what give us the tax expense to record in the profit or loss account. So we have it here, current year tax, we have under over provision, and then the increase or decrease in deferred tax, right? And this increase or decrease is the same as the movement in deferred tax. So we could have a deferred tax asset or deferred tax liability, right? So what you should know is that the whole standard IS 12 is about these three things. It's about getting your over and under provision, getting your current tax, and getting your movement in what? Deferred tax. So you're going to pick it one by one. We're going to pick the elements one by one, and then we look at it. So by the end of this lesson, you should be able to compute the income tax expense that we record in the profit or loss account together with other adjustment, right? Good. So let's pick the first element, over and under provision from the previous year, or over or under provision for the previous year. When we are done with that, we'll come and pick current tax, and then finally we'll pick the movement in deferred tax. We'll look at all these elements, we'll put them together, and we'll get our income tax expense for the year, the figure that will record in the profit or loss account, right? So let's start. Over or under provision. Over or under provision, and this normally from the previous year. Now let's say this year, let's say this is 2020, so we are in 2025, right? 2025. Now let's say last year, 2024. Last year, 2024, you an entity records or you record 40,000. Okay, you made provision of 40,000 in your profit or loss account, right? So you made provision of 40,000 as your income tax expense. But when the tax authorities in Ghana here, our tax authorities GRA, when GRA is done with the assessment, when they are done computing your income tax expense, they said your income tax expense or the tax payable should be what? 50,000. So you make provision for what? 40,000. The tax authorities are saying you should pay 50,000, or your tax expense or your tax liability, right? Or the tax payable is 50,000. You would realize that you have under provided for what? The tax expense. You have provided for 40, the tax authority saying you should make provision or pay 50. So you have under what? Provided. You made under provision, right? This happened in 2024. When you come to this year, 2025, you have to bring the 10,000 under provision to the current year and come and add it to this year's what? Tax, right? So with under provision, you add it to the current year tax, because last year or in the previous year, you couldn't fully, right, provide for your tax expense in a way, in quote, you couldn't fully pay. Let me use the word pay so that you get it, right? You made provision for only 40, The tax authorities are saying your tax liability is what, or your tax payable is what, 50. So you have under provided. So when it comes to this year, you have to come and add it, right? So in quote, you'll be owing them in quote, right? I'm saying provision. So in quote, I want to really get it. Let's look at the other way around. Now, this time, last year, in the previous year, let's say 2024, you made provision of 100,000 as your income tax expense in the P&L account. When the tax authorities, when they came out with the assessment, right, the tax authorities said your tax expense is what, or the tax payable is 70, or the amount you agreed with the tax authority 70,000, right? What have you noticed? You made provision for 100,000. The amount agreed with the tax authority is 70,000. So the tax authority are saying you should be 70,000. In this case, you have 30,000. I'm following. So the 30,000 is over provision because see, the tax authorities are saying you have to factor in what, 70. I'm following. They said you have to pay 70. You have made provision of what, 100,000. I'm following. So the difference is what we call over provision from the previous year. So when it comes to the current year, the 30, right, should be less from your income tax expense. The difference of 30 should be what? Less from your income tax what? Expense. Are you following? So the difference of 30 should be less from your income tax what? Expense, right? So that's it with over provision. So with over provision, when it comes to the current year, you have to come and less it because it has to what, reduce your income tax what, expense. It has to reduce it, okay? Because in the previous year you have overestimated the tax expense, right? So when it comes to this year, it has to reduce your income tax what, expense, right? So it says under or over provisions, right, from the prior periods is dealt with in the current year's tax charge. Yeah, so as I said, if you have made over or under provision from the previous year, when it comes to this year, you do the adjustment in this year. If you have overestimated, when it comes to this year, you have to come and less it. Because in a way, like you've paid more or you've made provision more than you are supposed to. So it's like an income to you. So when it comes to this current year, you have to come and less it. With under provision, last year or in the previous year, you could not really or you couldn't fully make provision. So in a way, you have made under provision. So when it comes to the current year, you have to come and add it because that should increase your current year what um it has to increase your current year charge, right? That's why this point says and under provision increases the tax charge, right? And under provision increases the tax charge. If you made under provision from the previous year, when it comes to the current year, you have to come and add it to the current year tax. So it should increase it. And over provision decreases the tax charge. If you have over provided in the previous year, when it comes to this, you have to less it to reduce your tax charge, right? Good. And it says a debit balance in a trial balance will represent an under provision. So when we start with the final account, you have your trial balance. When you see tax at the debit side, okay, it's two things. It's either it's a deferred tax asset or under provision. But normally the question will specify if it's a deferred tax asset, right? So mostly tax provisions or tax figures at the debit side are mostly under provision. They are what? Under provision. So when you see a trial balance and you see tax at the debit side, most certainly is supposed to be, or most certainly it will be a defer, sorry, it will be an under provision. So under provisions at debit side, because an expense you couldn't fully pay last year. So when you come here, it's still an expense which should be added. Okay, so we said a debit balance, okay, represents under provision, and it means that you could not fully make provision for your previous tax, right? So it's an expense which should be added to what, your current year tax. If you see a credit balance, or if it is a credit balance, if it has a credit balance, then it will mean over provision, right? Why is it over provision, or why is over provision having a credit balance? Last year or in the previous year, you have over provided. So it's like an income, right? You've made provision for income tax more than you're supposed to. So in a way, it's like income. So when it comes to this year, okay, when it comes to the current year, it should be reduced. It should be used to reduce your current year tax. Okay, that's why normally you see over provisions at the credit side. It represents an income. Okay, and under provision at the debit side, expense, right? And it says with the over provision, yeah, it should be credited to your P&L account, right? It is credited to your profit or loss account, meaning it should be used to reduce your tax expense. That's what it means. Okay, if you credit your P&L account, it means that you are taking that as an income, and that should reduce your what? Your tax expenses. So that's why we less over provision for the previous year, right? So you have to watch out. If you have under provision, you have to add to current year tax. Over provision, you less. Good. We have an example here. Let's solve this example. Let's solve this example. Right. So let's solve this example. Right. It says CM Professional Limited has estimated its income tax liability for the year ended 31st December 2023 at 180,000. In the previous year, the income tax liability had been estimated as 150,000. So 2023, CM Professional Limited estimated their income tax liability or their income tax liability as 180,000. Okay. In the previous year, they estimated it as what? 150. So in the previous year, they estimated 150, which is 2020 what? 2. By 2023, they estimated it to be what? 180. Let's get the requirement. It says required. Calculate the income tax expense that will be shown in the statement of profit and loss. Right? The statement of profit or loss for the year ended 31st December 2023. If the amount that was actually agreed and settled with the tax authorities in respect of 2022 was A, $165,000 and B, $140. Right? Now you check this one out. It says the amount agreed with the tax authorities in respect of 2022. In 2022, they made a provision of 150, right? We are in 2023 here, and they said in the previous year. So previous year is what? 2022. So in 2022, they made a provision of what? 150. That was the estimation. They made a provision of 150. But when it comes to 2022, it says, hey, the amount agreed with the tax authorities was 165. So they made provision of what? 150 in 2022. But the amount agreed with the tax authority in 2022 or with respect to the 2022 figure is 165. So in this question, do we have overestimation? Do we have under provision or over provision? They are provided for 150. The tax authorities are saying they should what? Pay 165. So in this case, they have what? Under provided. So there's what? Under provision, right? Why is it under provision? Because they have estimated it to be 150, but it came out to be 165. So they have what? Underestimated. So when it comes to 2023, the current year, you have to come and add it to the current year what? Figure, right? The requirement is that we should calculate the income tax expense. Okay, so here in this question, we have only two of the elements. We have the current tax and the over or under provision, right? So in the question here, let's start with the first part. Here we said it's under provision, right? So the under provision, okay, is how do we get the under provision, right? That will be the 165 by the tax authorities, okay, minus the provision that they have made. They've made a provision of 150, so they have they have under provided, right? And that will give us 15,000. So 15,000 is the under provision, and we said it should be added to the current year tax. So if you want to calculate tax expense, well, let's name this one tax expense for 2023, right? That makes sense. So let's make it tax expense for 2023. Okay, so tax expense for 2023. So we have 150,000. Sorry, we have 15,000. Then the current tax, we have to add the current tax, the estimated for 2023. So current tax, okay, is the 180,000. That's the tax for 2023. 180. 180,000. Okay, so that's it. You just have to add your underestimation or the underestimated amount to the current tax, because we said previously if you have underestimated your tax expense when it comes to the current year, because you have under when it comes to this year, you should what, increase your income tax what, expense. If you were to be over provision, we would have deducted. Okay, so the tax expense for the P&L will be the sum of the two. Are you following? So as simple as A, B, C, right? So you just have to know that if it is under provision, you add. If it is over, you deduct. So tax expense, okay, and the tax expense for 2023, okay, will be 195,000, right? So that's it. We are done with the A. Let's try B. B is saying with the same preamble, but B is saying in this time, or in this case, the amount agreed with the tax authorities were 140. So it's the same thing. They have in 2022, okay, they have made provision for 150, but the amount agreed with the tax authority in 2022 for B is 140. So they have provided for 150. The tax authority is saying they should pay what? 140. So they have overestimated the income tax liability. So here there's over provision. Okay, and we said to get the income tax expense, over provision is less. You have to less it because in the previous year, let's say you overpaid. So when it comes to this year, it should be deducted for from your tax expense. Then the remaining is what you pay to GRA. Okay, so that would be the 140,000 by the tax authorities minus the 150 provision that they have made. Okay, so we have over provision of what? 10,000. And this 10,000 should be less. It should be deducted from the current tax. It has to reduce our current tax. Okay, so we brought the over provision and the current tax. Our current tax, okay, is still 180. That's the current tax for the year. Okay, for 2023. So current tax is still 180. So in this question, you would realize that the over provision will come and reduce the tax expense. Okay, it will reduce it. It will reduce it. Okay, so when you factor this in, you realize that the tax expense, okay, for 2023 will be 170,000. Will be 170,000. As simple as that. So that's it with this question. So that's it with over and under provision. Very, very simple. What you do is just compare the previous amount that you have estimated with the amount agreed with the tax authorities. Okay, if you have estimated lower figure, then it is under provision. If you have provided more than the tax authorities are saying, then it's over provision. And we said under provision should be added because it will increase the current tax expense because we couldn't fully pay in the previous year. So you have to bring it to this year and add it. Over provision in the previous year, we have overpaid. So in this year, we have to come and less it from the tax expense before we pay the remaining amount to the tax authorities, right? So that's it with over and under provision. Let's continue with the second element, current tax. Okay, so current tax. As the name implies, current tax. So current tax is the tax that you are expected to pay in respect of your current financial statement, in respect of your current um, statement of profit or loss, right? So it says current tax here. Current tax is the amount expected to be paid to tax authorities by applying the tax laws or the tax rate in place at the reporting period. So with the current tax, is the tax that you are supposed to pay for the current period. How do we get it? You see, when you are done applying, when you are done preparing your financial statement, okay, your revenue, less cost of sales, you get your gross profit, you less your admin, you less your distribution, You less your finance cost, you add other income, then you get profit before tax, right? Then you can just apply the rate, just apply the tax rate on the taxable profit, okay, and you get your current tax. So it's very simple. So with the current tax, what we do is we just draft or redraft our profit or loss account. When we get profit before tax, we apply the tax rate, whether 25%, whatever rate that's applicable to that company, that entity, or applicable in that country. Just apply the rate on the profit before tax or on the taxable profit, and you get your current tax, right? And it says current tax is recognized in the financial statement by posting the following entries. It says we should debit P&L and we should credit uh tax payable. Yes, when we're looking at the elements, I mean the figures that we post to the profit or loss account as income tax expense. Can you see we added current tax? We said over or under provision. We said if it is under, you add, over you less. Then we add current tax. So what do? If you debit tax expense, you are adding, and we'll take it also as a liability. So it will be recorded in a financial position as a liability. That's why it says you debit tax expense and credit tax payable. Right? So we are adding it to income tax expense. That's why we are debiting it. Now, to compute your current tax, you have to do a lot of adjustments. Why? Because the way we compute the way accountants compute their tax, the way they compute their profit is different from the way the tax authorities compute their profit, right? In accounting, there are some expenses which are allowed to be deducted. They are deductible. Example is depreciation. You can deduct your depreciation, you can deduct your bad debt, you can deduct your general provisions for bad debt. But in tax, there are some items that are not allowed. Okay, so we have to do adjustments to what the profit. So we pick at accounting profit and we do adjustments to what to it. Okay, before we get a taxable profit. You see, if all expenses are allowed, right? Well, some accountants may try and put in all expenses in order to reduce their taxable profit to zero. Because the more the expenses, the expenses, the less your profit, right? So as I said, some might maneuver their ways or find ways of bringing in expenses, and then the more expenses you bring, the less the profit, right? So tax authorities, they don't really allow some expenses to be deducted, so they have to redraft the profit or loss account, and then they will get the correct or the taxable profit. Then they apply the tax rate on it to get the current tax, right? So it says a series of what adjustments, as I've said, a series of adjustments is made, okay, against the company's accounting profit to arrive at its taxable profit. So the difference between accounting profit and the taxable profit. Accounting is the profit that accountants we get when we do our things, when we bring all our income and we less all our expenses. With the taxable profit, it is the revised accounting profit, right? After we are done doing the adjustments, okay, to the accounting profit, then we get the taxable profit. So since these adjustments involve adding back inadmissible deductions, example accounting expenses which are not allowed as deduction against taxable profit, and then deduct admissible deductions which include expenses that are allowable as deduction against taxable profit but which have not been recognized in the financial statement, and income recognized in financial statement but which is exempt from company income tax. You know what they're saying? What they're saying is nothing. You know, we less expenses to get profit. So it says if the expense is not deductible, that is inadmissible. It's not just using some English, right, to confuse us, but it's nothing. It says you should add back inadmissible deductions, meaning deductions that are expenses that are not allowed for you to deduct, add them back. Because when you deduct the expense, you're reducing profit. So it says, okay, if you deduct the expense, you're reducing profit. If that expense is not allowed, add it back. I'll take you through an example in just a minute. I'll take you through an example and see how it is. It's very simple. Okay, don't be scared with this admissible, inadmissible. It's nothing. They're just saying we deduct expense to get profit. So expense that you have deducted but are not allowed, add them back. Then it says you should deduct admissible deductions right? Which include expenses that are allowable as deduction against total profit but have not been what recognized. So there are some expenses which are allowed in the tax from the tax perspective or from the perspective of the tax authorities allowed. For those ones, if they are allowed but we've not yet deducted them, it says you can deduct them. So go and deduct them. Okay. And then it is an income recognized in the financial statement but which is exempt from company tax. You see, how do we get that profit? We said we add all our income, we less all expenses, and we get that profit. Some income are not taxable, they are exempt, right? In Ghana here, some incomes are exempt from tax. Some are final withholding, right? So it says if there's income that's exempt from tax, but you have added it to your income, and therefore your profit has increased, go and less it, go and deduct it. That's what they're saying, right? So this thing is nothing like add back, disallow. It's not really anything. Ask yourself, how did you arrive at profit? If you less the expense and the expense is not um, deductible, it is inadmissible, go and add it back. If you include an income and that income has increased your profit, but it is not taxable, go and less it. That is all. The tax rate is applied to the taxable profit, right, to calculate how much a company owes in tax for the period. So we said when we are done with all your add back and then disallow, add back and then less. And then when you are done with your add back and then your lesson, the taxable profit that you get, apply the tax rate on it, and that will be your current tax. Let me show you something small, right? Let me show you something. Okay, now look at this. This is an extract like of a profit or loss account. I just give this example to just explain something, right? Look at this. You realize that we have sales, okay, sales revenue, we have dividend received, which is an income, so was added interest received. So we added all the income and then we got total income. Then we less the expenses, cost of sales, depreciation, bad debt, salaries, and then we got profit before tax of what 2,000. Now let's assume I'm saying assuming we'll go back and look at which expenses are deductible and which are not deductible. We'll look at it, but I'm just giving a scenario here. Let's assume that dividends is not taxable, okay, and depreciation is not deductible. So if we are not, okay, if we are not taxing dividend, or if it says dividend is what not taxed, it means we'd have to include dividend here and tax it because dividend here is an income. So it has increased your taxable profit. So if it says dividend is not taxed, what does it mean? Because it was included here, it was added to revenue and it increased profit. So we are going to less the dividend because it was included as an income and it increased profit. So if it's not taxable, you have to what? Less it. Then with the depreciation once again, because it was deducted, it's an expense, it was deducted before getting profit. Profit is reduced from we deducting the depreciation. So because that reduced profit, you have to go and what? Add it back. So if you want to redraft, okay, we start with what we call the net profit or profit before tax, whichever way you can do it. It's supposed to be before tax. So profit before what? Your tax. How much is it? The 2,000. Let's pick 2,000 and adjust. So we said with when we get this figure here, with the dividend, because it's an income and then they've added it, it increased profit. So we have to what? Less it. So we have to less the dividend. How much is the dividend? I didn't spell it well. 5,000. So we have to less it. Then we come to the expense depreciation. Depreciation was less before getting profit, so it reduced profit. Okay, it was less before getting profit, and so it reduced profit. So we have to add it back. So let's add back the depreciation. So we add depreciation. How much is it? 15,000. Now, when you are done doing this adjustment, what do you get? you get, so we have here we have 2,000 minus 5,000, right? Plus 15,000, and this will give us 12,000. Okay, as the adjusted profit or taxable profit. So this will call the taxable profit, right? So our taxable profit now is 12,000. Okay, it's 12,000. We can also do this way. We can do this way. We can now go, this time we have to go and redraft all the things again. Okay, so we'll start with revenue. Okay, I'll use the same things here. We will start with revenue. This time we will go and redraft everything, but we will exclude the dividend and the depreciation, right? Okay, so we said we can also do it this way. We are going to redraft the P&L account. By this time, we'll exclude the dividend and then the depreciation, right? So we will do it the normal way. We'll get the same answer. So revenue is 20,000, right? Then we come to cost of sales, or we come to the next one, which is so we less the dividend, we exclude the dividend. Then we look at interest. How much is the interest? The interest is 10,000, right? Then we have total income of what? 30,000. So it's like when you underline here, your income will be 30,000. At first it was 35 because of the dividend, right? So total income is what? 30,000. Then we come to the expenses. The expenses, cost of sales, we said is deductible. So we can deduct cost of sales. So cost of sales is 10,000, be less. Then we have depreciation. We are not going to touch it because it said it's not deductible. So it means we are not going to touch it. Okay. We will not touch the we will not touch the depreciation. It's not we said it's not deductible. We assume it's not deductible. Bad debt, we said it's deductible. So we will let the bad debt. How much is it? 3,000. Then we have salary. So salary. So with the salary, we have 5,000. Okay. So you see, when you check all these ones out, when you do this one like this, we have 30,000 minus the 20. Sorry, 30,000 minus the 10,000 minus 3 minus 5, right? So this should give us the same 10. It should give us the same stuff, right? Because we are going to have the income as 30,000 and then the expense now will be 18,000. So when you do that, you should get the same 12,000 as the taxable profit. So have you seen how it works? Okay, so it's either you redraft, you pick everything and redraft them again, okay, or you pick the net profit and all expenses that were deducted, but they are not supposed to be deducted, add them back. All income that were added, but they are not taxable, deduct. That's all. Okay, so that's it with this. I hope you understand the add back and then the disallow, right? So let's continue. Okay, so that's what we have here. Okay, what I've just explained is what we have here. So you bring your accounting profit before tax, then add back inadmissible deductions, right? So all expenses that were less, that were deducted, but they are not supposed to be deducted. Okay, that were deducted, but they are not supposed to be deducted, or they are not allowable. The tax authority will not allow them to be deducted. You add them back, and this is less admissible deductions. These admissible deductions, we have income that was added, okay, and so profit increased, but they are not taxable. We said if there's income that has been included, right, it will increase profit. If that income is not taxable because it was added and profit increased, let's go and less it. Okay, And also if there's any expense that is allowed for deduction, but we are yet to what? Deduct. Go and deduct. Right. So these things here, they're nothing, these admissible expenses, and then inadmissible and admissible, it's nothing. So that's it. If it is income and it is if it's income and it's not taxable, okay. If it's income and it's not taxable, if it has been included in the P&L account and it's not taxable and it is income, they have to go and what? Less it, because it will increase profit. So go and less it. If it is expense that was deducted but it's not deductible, GI will not allow you to deduct, okay, that will reduce profit. So go and add it back. If there's any other expense that's allowed to be deducted, but we have not yet deducted that, when deduct, right? So that's all. When you get the answer, apply the tax rate on it, and then you get your current tax. So this is how we go about current tax, right? Now, let's break here. We'll continue. In the next example, we'll solve this question. In the next video, we'll solve this question. It's a very nice question. It has everything, right? We are going to compute the current tax. We have capital gain here. We have borrowing cost, expenses that are allowed and those that are not allowed. We compare it with the tax regime. Okay, we compare it with the tax regime of this particular country, and then we'll look at how to go about it, right? So I'll see you in the next video where we continue with IAS 12 income taxes.